China is holding $3.2 trillion in US dollar-denominated assets, including government bonds, corporate bonds, foreign exchange reserves, and mortgage-backed securities. No country on the planet has as much exposure to the US dollar as they do. More than Japan, more than the UK, and even more than the entire European Union combined. And for many years, analysts, politicians, and financial media have warned about a terrifying scenario. What would happen if China sold off all of these assets? What would happen if they decided to turn their holdings of bonds into a financial weapon and launched a massive sell-off? The dollar would plunge, interest rates would skyrocket, and the US government would face a financial crisis. America's position as the world's leading economy could collapse overnight. This scenario is described as the nuclear option, a financial weapon of mass destruction, China's ultimate trump card that keeps US policymakers awake at night. But there is a truth few people talk about. China cannot use it. Not because they don't want to, but because they simply can't. Because the moment they pull the trigger, they would destroy their own economy. Not just damage it, destroy it entirely. This $3.2 trillion is not a weapon, but a trap, and both the US and China are stuck in it, with no way out. This is the most sophisticated case of financial hostage-taking in history. Two superpowers facing each other, each pointing a gun at the other's head. Both know that if either one pulls the trigger, they will both be destroyed. And the truly frightening part is not what could happen, but what is quietly happening right now. It is a slow-motion collapse unfolding day by day. China knows it is trapped, and for the past 15 years, they have been quietly trying to escape. They are buying gold, building alternative payment systems, and gradually restructuring their economy to reduce dependence on the US dollar. But the trap is too deep and the dependence too great, making escape a process that takes decades. And the real question is not whether they can escape, but whether the trap will collapse before they can. Let me show you exactly how this trap operates, why escaping it is nearly impossible, and what is happening right now as both countries try to find a way out without triggering mutual destruction. It starts with what is called the weapon, China's US dollar-denominated assets. As of July 25, China holds roughly $731 billion in US treasuries. This is the official figure published by the US Treasury, and notably it is also the lowest level. Since January 2009, 16 years ago, China has been steadily cutting its holdings of US treasuries for many years, and in July 2012 alone, they sold $25.7 billion worth. This is not a minor adjustment. It is the sharpest monthly reduction in nearly 2 years. This move pushed China from second place down to third. Among the largest holders of US debt, Japan still holds around $1.1 trillion, while China has fallen to third place. And the real picture doesn't stop there. It goes much further. China also holds a massive amount of US corporate bonds as well, from technology companies to financial institutions and industrial conglomerates. The estimated value ranges from $300 to $500 billion. In addition, they also hold a large amount of dollars as reserves, foreign exchange reserves, not invested but kept as currency, amounting to between $500 and $700 billion. They also own mortgage-backed securities in the US, including products from Fannie Mae and Freddie Mac. The kinds of securities that once dragged the entire world into crisis in 2008. After the crisis, when these assets' prices collapsed, China bought hundreds of billions of dollars worth. Currently, the amount of these mortgage securities is estimated to be around $200 billion. In addition, they also hold shares in many US companies through sovereign wealth funds and state-owned enterprises. According to estimates by BlackRock, entities linked to the Chinese government hold between $1 and $1.5 trillion in US equities. When adding everything together, US government bonds, corporate bonds, foreign exchange reserves, mortgage securities, and equities, China's total exposure to the dollar is estimated to be between $2.8 trillion plus and $3.5 trillion. The most commonly cited figure is $3.2 trillion. Not because it is perfectly accurate, but because it represents the average estimate that most experts agree on, considering it the clearest reflection of the dollar trap that China is caught in. And this is why the figure is important. Not just because it is large, but because it is structurally embedded in the entire economy. This is not money that China can easily move or withdraw. It is tied into their entire economic system. China accumulated this massive amount of dollars over 40 years through a single mechanism, trade surplus. From the 1980s to the 2000s, China consistently maintained the largest trade surplus in modern history. They exported manufactured goods to the entire world, from electronics and textiles to machinery, toys, furniture, and countless other products. The world paid for these goods in dollars. And Chinese exporting firms received those dollars, then brought them to the banks to exchange for yuan. The banks then transferred all the dollars they received to the People's Bank of China. The Central Bank of China was forced to find ways to use the enormous inflow of dollars each year. They couldn't just keep cash, because cash yields no return and loses value to inflation. So they had to invest the money. U.S. Treasury bonds became the obvious choice, as they are considered the safest assets in the world. This is the largest bond market, and the most liquid, backed by the U.S. government's taxing power. More importantly, buying U.S. treasuries served another purpose: to keep the yuan consistently weak. Every time China buys U.S. bonds, they have to sell yuan and buy dollars. This causes the yuan to be undervalued relative to the dollar. A weaker currency makes Chinese exports cheaper to American consumers. Cheaper goods lead to higher sales. Higher sales bring more dollars into China. More dollars lead to more purchases of U.S. government bonds, a self-reinforcing cycle. China's entire export-driven economy was built on this mechanism. The $3.2 trillion that China holds is not a challenge to their economic model, but the foundation of it. This amount of dollars is the result of accumulation over 40 years of export-driven growth. It represents the savings of an entire nation. And that is the first layer of the trap. Now let's talk about an imaginary scenario, but one that politicians and analysts like to use to sow fear. What would happen if China dumped its entire $3.2 trillion in assets? In theory, the scenario goes like this. China calls its bond traders and gives them a single order: sell everything. All $731 billion of U.S. Treasury bonds would be thrown onto the market at once. The U.S. Treasury market, considered the most liquid market in the world, would immediately be paralyzed. There would be no way to absorb such enormous selling of $731 billion without causing a severe price shock. Bond prices would plummet, and when prices fall, yields rise. The 10-year Treasury yield, currently around 4.5%, could surge to 8% or even 10% or higher, depending on market panic. That's just the immediate impact, but the chain reaction wouldn't stop there. Mortgage rates in the U.S. are priced based on the yield of the 10-year Treasury. So if that yield jumps to 10, then mortgage rates would shoot up to 13 to 14%. The housing market would freeze completely. No one can buy a home at a 14% interest rate. Home prices would crash hard. Consumer spending, which makes up 70% of the U.S. economy, would collapse because Americans' biggest asset, their homes, would lose value. Businesses also couldn't borrow because borrowing costs would be too high. Companies needing refinancing would face interest rates of 12 to 15%, a burden nearly impossible to bear. Many businesses would fail to repay debts, triggering a wave of defaults. The credit market would freeze. Banks holding U.S. Treasuries as assets would see the value of their assets plunge, collapsing their balance sheets. A banking crisis would emerge, and the Federal Reserve would be forced to intervene. They would have to buy back the bonds China dumped to stabilize the market. But to buy $731 billion worth of bonds, the Fed would have to print $731 billion new dollars, meaning an unprecedented expansion of the money supply outside of wartime. Inflation, which the Fed has spent years trying to control, would explode again. The dollar would plummet in the foreign exchange market. As the dollar weakens, import prices soar. Everything Americans buy from abroad, from phones, cars, clothing to food, would double in price. Inflation could hit 20 or even 30% a year. The economy would enter stagflation with high inflation, high unemployment, and declining growth. And here comes the heaviest blow. The U.S. government's borrowing costs would explode. Right now, the U.S. government pays about $1 trillion every year in interest on its national debt. If yields double, interest expenses would jump to $2 trillion. That figure is higher than the defense budget, Medicare costs, and a large part of Social Security combined. The U.S. government would fall into a severe financial crisis as funding dries up. They would be forced to slash spending dramatically or print more money to fill the budget gap. And either choice would accelerate the crisis. This is the nightmare scenario, what's often described as a financial nuclear weapon, where China only needs to press a button and the U.S. economy collapses. But here's the truth. The moment China dumps all those bonds, it would destroy itself, even faster than it could hurt the U.S. Let me explain exactly why, starting with the most immediate impact, which is the collapse of the U.S. dollar. When China dumps onto the market $731 billion in U.S. Treasury bonds, along with selling off its dollar reserves, the value of the dollar on the forex market will plunge. Suppose that within just a few short weeks, the dollar loses about 30% of its value against other currencies. That would certainly be catastrophic for the US. But it would be far worse for China, because it is still holding $2.5 trillion in other USD-denominated assets, including corporate bonds, mortgage-backed securities, foreign reserves, and equities. The moment the dollar loses 30% in value, China instantly loses 30% on those assets, worth $2.5 trillion. That is the equivalent of $750 billion in just a few weeks, completely wiped off their balance sheet. China's financial system operates on dollar liquidity. Chinese banks borrow dollars from global markets to obtain capital for domestic lending. Chinese corporations also issue dollar-denominated bonds because dollar interest rates are often lower than yuan interest rates. When the dollar collapses and U.S. interest rates spike to 10%, every Chinese company and bank that has borrowed in dollars will immediately fall into a refinancing crisis. They must repay in dollars, while most of their revenue is denominated in yuan, and the yuan has just surged 43%. This makes their repayment costs rise by exactly 43%. China's total corporate debt is currently about $28 trillion, and roughly $3 trillion of that is dollar-denominated. When exchange rates swing by 43%, Chinese companies must shoulder an additional $1.3 trillion in real costs. Most cannot pay, and a wave of defaults will spread. Chinese banks that lent to these companies or hold their bonds will suffer heavy losses, and a banking crisis will erupt. The government will be forced to bail out the system. But it has just lost $750 billion in foreign reserves, so it no longer has enough resources. They will have to print more yuan to cover the losses. That is monetary expansion, and the result is inflation in China, which has been tightly controlled for years, will explode violently. Chinese citizens who keep most of their wealth in real estate and yuan-denominated savings will see their purchasing power evaporate rapidly. This leads to social instability, and here comes the final blow. China must import almost all of its energy, including crude oil, natural gas, and coal. These energy commodities are all priced in dollars on global markets. When the dollar collapses, but oil is still quoted in dollars, China will have to pay far more yuan for the same amount of energy. Energy costs will double, immediately driving inflation even higher. China's manufacturing sector, which relies on cheap energy, will become less competitive. The entire economy will slow down and nearly stall. In total, as China sells off $3.2 trillion in assets, it also loses $750 billion in the process on what remains. Its export economy collapses because U.S. consumer demand disappears and the yuan surges, making Chinese goods uncompetitive. The corporate sector falls into a debt crisis due to exchange rate shocks, and the banking system struggles. The government must print more money. Inflation surges and energy prices double. Social unrest emerges, and all of this happens far faster than the damage the U.S. because China's economy is far more fragile. The U.S. has the deepest capital markets in the world, one of the most diversified economies, and most importantly, the Federal Reserve, which can print dollars to stabilize the system when needed. China has none of these advantages. The yuan is also not a global reserve currency. In times of crisis, almost no one wants to hold yuan. China's capital markets are both smaller and state-controlled, and its economy heavily depends on exports and imported energy. So when the dollar trap detonates, China will fall far faster than the U.S. This is why the $3.2 trillion that China holds is not a weapon, but a position in which it has taken itself hostage. The nuclear option, many fear, is essentially China pointing a gun at its own head, and both sides know it. So if China cannot dump its dollars, what is it really doing? It is trying to escape the trap slowly, very slowly, over decades. Their strategy rests on 3 pillars. The first pillar is gold accumulation. The second pillar is alternative payment systems. China has built infrastructure to conduct international trade without using the dollar. One example is the cross-border interbank payment system, CFS, launched in 2015. This is China's alternative to SWIFT, the dollar-based network. The processes most global transactions. CFS allows Chinese banks and even foreign banks to settle payments directly in yuan without passing through the dollar system. As of 20, CFS handles around $14 trillion in transactions each year. Still small compared to SWIFT's 150, but growing at 30% annually. In addition, China has signed bilateral currency swap agreements with dozens of countries. These agreements enable direct exchange between the yuan and the partner's local currency without converting through the dollar. China now has swap lines with Russia, Brazil, bilateral agreements with dozens of countries. These agreements allow direct exchanges between the renminbi and the partner country's local currency without having to convert through the dollar. China currently has swap lines with Russia, Brazil, Argentina, Saudi Arabia, the UAE, Pakistan, and around 35 other countries with a total value exceeding $500 billion. China's goal is to build a trade bloc that uses the renminbi, in which imports and exports are both priced and settled in renminbi instead of the dollar. If China buys oil from Saudi Arabia in renminbi, and Saudi Arabia uses that renminbi to buy Chinese goods, the entire transaction cycle would completely bypass the dollar. There would no longer be a need for dollars, and no need to hold dollar reserves. This is the long-term escape plan, to shift enough transactions into renminbi so that China's export-driven economy no longer depends on accumulating dollars. But the problem is this takes decades to accomplish. You can't force the entire world to use the renminbi. Countries only use the renminbi when it's beneficial for them. And right now, for most countries, the dollar is still far more convenient. The dollar is accepted everywhere, and dollar-based markets are far deeper. Contracts denominated in dollars are protected by US law, which most countries trust more than Chinese law. So this transition is happening very slowly, only increasing by a few percent each year. The share of global trade transactions settled in China's renminbi has risen from 2% in 2015 to around 7% in 2025. That's progress. But at this pace, it would take roughly 30 years to reach 50%. And China doesn't have 30 years because the dollar trap is operating. Right now, the third pillar of the escape strategy is shifting toward domestic consumption. China is trying to rebalance its economy, reduce its dependence on exports, and increase the role of domestic consumption. If Chinese citizens consume more of the products made in China itself, the need to accumulate dollars through exports would decrease. This policy has been part of the official agenda since 2013. The government's goal is to raise the share of consumption in GDP from 38% to 60% within 20 years. They've built more infrastructure, expanded social services, increased wages, and tried to shift the focus of the economy from investment and exports to consumption and services, and this process is gradually paying off. The share of consumption in GDP has increased from 38% in 2010 to 55% by 2025. But this creates a new problem. As wages in China increase, China's exports become less competitive than they've been for decades. The reason China dominated global manufacturing was low-cost labor. As labor costs rise, factories have begun moving to Vietnam, Bangladesh, Mexico, and many other countries. China's trade surplus, which once peaked at $400 billion per year in 2015, has dropped to around $250 billion by 2025. This means fewer dollars are flowing into China than before. It may sound like they're escaping the dollar trap, but in reality, China still holds $3.2 trillion in USD-denominated assets accumulated over the years. The trap doesn't shrink just because fewer new dollars come in. China needs to actively cut the $3.2 trillion number down, but they can't sell it off without crashing the dollar. So they're completely stuck. Shifting to domestic consumption only reduces the dollars they'll need to accumulate in the future, but does nothing to solve the massive reserves they already hold. Now let's talk about time. How long will it take to escape this trap? And what does that mean for the dollar? China began this process in 2008, right after the financial crisis. That was when Chinese leaders realized the dollar-based system was too fragile, and they were overly dependent on it. 17 years have passed, and by 2025, they've made some progress. Gold reserves grew from 600 tons to 2,330 tons. According to official figures, real numbers may be 5,000 to 6,000 tons. The share of global trade settlement, done in renminbi, has risen from 0% to 7%. China's holdings of U.S. Treasury bonds fell from $1.3 trillion in 2013 to $731 billion in July 2025. The trade surplus is gradually shifting from exports toward domestic consumption, but they've only completed about 25% of the journey away from dollar dependence. At the current pace, full diversification will require another 20 to 30 years. That means not until around 2045 to 2055 will China's dependence on the dollar drop below $1 trillion, a level at which they could sell without destroying their own economy. The critical question is whether the current system can last that long. Because China isn't the only factor. The U.S. is adding $2 trillion of debt per year as of November 2025. Total U.S. national debt has reached $38 trillion. Annual interest payments are nearing $1 trillion. That's equivalent to 14% of total federal spending. The Federal Reserve has printed trillions more dollars, and inflation persists. So, the dollar as the global reserve currency is weakening. Not because China is attacking it, but because the U.S. itself is eroding its own currency from within. If the dollar collapses on its own, before China can escape the trap, China would suffer catastrophic losses. This is a race to see who can hold on longer. Can China diversify fast enough before the dollar collapses on its own? Right now, the answer is no. The timelines don't match. China needs 20 years to escape its dependence on the dollar, while the dollar's structural problems could trigger a crisis in just the next 5 to 10 years. That means China is completely trapped. They can't dump dollars without destroying their own economy. But they also can't keep holding dollars, because when the dollar collapses, they lose everything. This is a situation where both choices lead to disaster. And even more interestingly, the US is trapped too. US policymakers understand very clearly that China holds $3.2 trillion. They know that in theory, China could dump that entire stockpile. And so US policy is heavily restrained. Washington cannot be too tough on Beijing, because China can retaliate financially. This is why sanctions on China are always far more cautious than those on Russia. When Russia invaded Ukraine, the US froze $280 billion of Russia's foreign reserves, essentially confiscating them, blocking Russia from accessing its own money. This was the most powerful financial strike the US ever used. But the US cannot do the same to China, because China holds $3.2 trillion. If the US froze those assets, China would have nothing left to lose and would immediately dump everything else they hold. Even though that would destroy China too, they could still drag the US down with them. This is mutual financial destruction. And so the US must act cautiously. They can't pressure China too aggressively, can't freeze assets, can't cut China out of the SWIFT system, and can't deploy their full financial arsenal against China. China's dollar-denominated assets function as a deterrent, not as a weapon of attack, but as a barrier that stops the US from acting freely. And China understands this very well. This is also why they cannot diversify any faster. If China sold $500 billion of US treasuries within a single year, the market would panic, and the US would see it as hostile action. Bilateral relations would collapse, and sanctions would inevitably follow. China would lose access to US technology, the US market, and the US financial system. These economic losses would far exceed any benefit they gain from escaping the dollar trap. So both sides are stuck. China cannot dump dollars without destroying itself and provoking US retaliation. And the US cannot use the dollar as a weapon against China, because doing so would trigger a crisis that could destroy the US economy itself. This is the most sophisticated financial standoff in history, and almost no one realizes it, because both sides pretend it doesn't exist. Even China's slow escape process is ironically helping to strengthen the dollar in the short term. Each year, they buy fewer US treasuries, but they are not aggressively selling what they already hold. The sale of $25.7 billion in July 2025 sounds big, but it was actually calculated and tightly controlled. This means demand for US treasuries is declining gradually, not collapsing suddenly. US interest rates therefore rise slowly instead of spiking, and that level is still within US control. The Federal Reserve can adjust, the market can adapt, and nothing has turned into a crisis yet. It's more like a slow erosion. And every slow erosion eventually reaches a breaking point, usually when global dollar reserves fall below 50% of central bank reserves worldwide. Around the world, confidence will be shaken. Other countries, seeing China reduce its dollar holdings, will follow suit, and the pace of change will accelerate. What once moved slowly will turn into a powerful wave. That is when the dollar loses its status as the global reserve. Not because China attacks it, but because of market dynamics. Now in the year 2025, the share of global reserves in dollars ranges from 56.3 to 57.7%, depending on the quarter, down from 58% in 2024, and far lower than 72% back in the year 2000. This means the dollar has lost roughly 40 to 16 percentage points of market share over 25 years. If this pace continues, that share will reach 50% around 2030 to 2032. But the rate of decline is speeding up. In recent years, the drop has been steeper. And if this trend continues, the 50% threshold could arrive as early as 2028. And here's the key point. Once the share of dollar reserves falls below 50%, the question is no longer whether the dollar can maintain its position, but what will replace it. That is when currencies of the Beresay bloc, gold-backed systems, and regional monetary unions start to become viable. Once that happens, the shift accelerates and may turn into a crisis. And the notable thing is China doesn't need to do much. They only need to continue their slow diversification while the structural problems of the dollar will weaken the system on their own. Now let me show you the biggest paradox. Both countries are trapped, but the trap was created by the very mutual benefits they once shared. For 40 years, from 1980 to 2020, the relationship between the dollar and China was a mutually beneficial exchange. China gained the opportunity for rapid industrialization thanks to exporting to the US. Hundreds of millions escaped poverty, and China rose to become the world's second-largest economy. The US, meanwhile, enjoyed cheap goods, store shelves at Walmart filled with $20 ovens or $50 televisions. Americans' purchasing power increased, even though wages barely moved, because everything became cheaper. American corporations made huge profits by shifting production entirely to China, from Apple and Nike to Gomer. The stock market surged. The US government benefited from cheap borrowing costs because China reinvested its dollars from trade surpluses into US Treasury bonds, helping keep US interest rates low, allowing the US to maintain massive budget deficits with almost no consequences. Both sides gained enormously, but the very mechanism that created those benefits also built the trap they're in now. China's industrialization process depended on accumulating large amounts of dollars, and the cheap goods Americans enjoyed for decades depended entirely on China's manufacturing capacity. The level of mutual dependency became so deep that neither side can exit without collapsing the very structure that brought them both so many benefits. And now, after 40 years, the system is cracking. Rising labor costs in China mean their exports are less competitive than before. Interest payments are skyrocketing, and the benefits of the old model are steadily declining. Yet the trap still remains. Both want to escape, but neither can do so without paying a catastrophic price, a devastating price. This situation is like two climbers, tied together by a single rope dangling on a cliff. If one slips, they both fall. So both are trying to find new footholds, new positions and ways to stand firm, without relying on the other. But this process takes years, and while they seek change, the cliff itself is gradually crumbling. The question is not whether. Both sides realize the trap, because they know it very well. All central bank governors, finance ministers, and economic experts understand the situation. What they worry about is whether escape is possible before the cliff completely collapses. And here's what will happen next. Over the next 5 to 10 years, you will see China continue its slow but steady diversification strategy. They will buy more gold, sign more trade agreements in RMB, and promote domestic consumption. At the same time, you will see the US continue to weaken the dollar, spend more deficits, print more money, and endure prolonged inflation. Thus, the global dollar reserves will continue to erode. The dollar reserve ratio, currently at 50, could drop to 50 by 2028, and even 40 by 2030. And during this decline, one of three scenarios will occur. The first scenario is an orderly transition, where the dollar remains important, but no longer the dominant reserve currency. The world moves to a multipolar currency system. The RMB dominates Asia. The euro dominates Europe. And the dollar remains on top in the Americas. No crisis, just gradual adjustment. This is the most optimistic scenario. And it requires both the US and China to act extremely wisely. Geopolitics must remain stable, and no severe economic shocks occur. The probability is roughly 20%. The second scenario is a crisis-driven transition, triggered by an event like a debt ceiling breach, the collapse of a major bank, or geopolitical tension that could suddenly destroy global confidence. China is forced to sell dollars to protect itself. The US retaliates, and a scenario of mutual destruction unfolds. The result is a global financial crisis, deep recession, and monetary chaos. Eventually, everything stabilizes, but only after massive wealth is wiped out. The probability of this scenario is up to 50%. The third scenario is the trap collapsing simultaneously for both the internal problems of the dollar, like debt, deficits, and inflation, cause the system to collapse before China can escape. China suffers catastrophic losses, around $3.2 trillion. Their economy plunges, and the US economy also struggles because of the dollar's collapse. And China is still trapped, so it suffers more severely. Both countries fall into a prolonged economic crisis. There are no winners, only mutual losses. The probability of this scenario is about 30%. None of these scenarios are positive. The best scenario is a controlled decline. The worst is mutual destruction. And the most likely outcome lies between the extremes. That is, a chaotic crisis leading to the risk of mutual destruction. The important thing you need to understand is this is not about choosing sides, not the US versus China. It's about recognizing that the world's two largest economies are locked in. This is not the US against China or China against the US. It's about recognizing that the world's two largest economies are locked in a financial structure that benefits no one, yet binds them both. And this structure is extremely unstable. The $3.2 trillion figure is not a weapon China can use against the U.S. It is a burden both countries must bear. As the dollar continues to weaken, as U.S. national debt surpasses $38 trillion, it continues to rise while China seeks an escape route. The instability grows. You are witnessing the slow collapse of the financial architecture that has shaped the world for the past 40 years. And as this structure breaks down, choosing sides between the U.S. or China becomes irrelevant. Because all your savings, investments, and purchasing power are tied to currencies trapped in this structure. The dollar will lose value. The yuan will fluctuate wildly, and whichever way the transition occurs, it will destroy massive amounts of wealth. Unprecedented since the 1930s. This is why understanding this trap is not because you can change the outcome. You cannot. But because you can prepare to place yourself outside its range of damage. Gold, Bitcoin, tangible assets and businesses that generate real value are outside. The situation of being trapped between both the dollar and yuan are caught in this trap, you must hold on to what is not bound by it. The $3.2 trillion trap is the most important financial driver in the world right now. Yet almost no one notices, because both governments pretend China doesn't mention it, as admitting the trap means admitting weakness. The U.S. also avoids it, because acknowledging it could reveal China's leverage and cause panic. So both remain silent, continuing their slow strategies, hoping to escape before the cliff collapses. But the cliff is cracking daily, and time is running out. If this changes how you view U.S.-China relations, if you understand why neither side can win this confrontation, then you are starting to see the real structure of the global financial system, not the stories politicians tell, nor the fears the media spreads, but the actual workings of the trap. Watch closely if you want to know how this will unfold. Because in the next 5 years, this trap will either gradually be dismantled or collapse catastrophically. Whichever way it goes, it will remain the most important financial story of the decade. If you find this content useful, and it truly gives you a new perspective, remember to like the video, subscribe to Knowledge Station, and share it with friends to spread this value. Your support motivates us to continue producing deeper content and even higher quality, and share it with your friends to spread this value. Your support is the motivation for us to continue producing in-depth content and even higher quality.